Thanks for watching Lessons in Minutes with Jaylee. Like, share, and don't forget to subscribe.
What would you do if you have gone to a store and it is looking like this? What would you do? Would you still purchase something from there? Because what I'm seeing right here is just chaos. I wouldn't be able to pick out something that I would practically need. This would probably take me the entire day to go through and find something that would be useful to me, that would be worthwhile, right? Something that would grab my attention. And looking at a store like this, it will just turn away customers because I would not stop and purchase something in the store. I may have used this store. This one is more organized. If you look, it is basically from what I'm seeing, it is based on color, based on gender as well, right? Things that you can match, etc. So this would give me a better shopping experience, right? Because think, what if I like yellow? I could go to this corner and pick out something that is yellow because sometimes you're going to an event and there's a color scheme, right? So organizing the store would give the customer a better shopping experience, as well as the persons, the owners would know that, oh, we need goods to stock in this area, etc. Right? Also, even this one could give you a better shopping experience as a male, right? So organization plays a huge part in any business that you are operating, whether it be by way of organizing the goods that you are selling, or even as simply as doing your accounting records. A business that is in operation will have several transactions, a lot of transactions daily, weekly, monthly, etc. So when you look at a compilation of all those transactions for the reporting period, for the accounting period, what if everything was all over the place in one, just like jumbled, just like the first picture that we have looked at of that store with the clothes all over the place? It means that there will be a mess, right? You would not know the amount of the total for credit sales for the period, the amount for credit purchases for the period, etc. So what we're going to look at in this lesson is the topic books of original entry. Our objectives are, at the end of a lesson, you should be able to explain uses of the 7 types of books of original entry. And the second one is identify source documents related to each book of original entry. Now, bear in mind that, remember, we look at 6 stages of the accounting cycle. What we will be doing today is looking at those 2 first stages, just an introduction to those two, which are the source documents, which is the first stage, and the books of original entry, which is the second stage where you do journalizing. So we're going to look at what is books of original entry. And these are books of first entry where transactions are listed prior to being posted to the double entry records. So the books of original entries where you would make a recording of each transaction, and those transactions would then be classified in the different types of books of original entry based on the nature of a transaction. And then you would do your posting to your ledgers using your double entry concept. Books of original entry is also known as books of prime entry or subsidiary books. So those are 2 alternative terms for books of original entry. What is source documents? So we're going to look at that. These are documents that provide information from which accounting records can be prepared. So, for example, your receipts, your invoice, your bank statement, your check counter foil, etc. Those are source documents. From those, you would gather the evidence that a particular transaction actually took place. And it is from your source documents that you will prepare each book of original entry based on the nature of the transaction and the type of the source document. We're now going to look at the types of books of original entry. As indicated earlier, there are 7. The first one is purchases journal, also known as purchases book or purchases day book. Next, sales journal, which is also known as sales book or sales day book. Following that is returns inwards journal, which is also known as sales returns journal or sales returns book. We have returns outwards journal, otherwise known as purchases returns book or purchases returns journal. We have the cash book, which is simply receipts and payments. We have petty cash book, which is the small payments book. And the final one is the general journal, which is simply the journal. So those are the 7 types of books of original entry. We're going to look at what each book of original entry is used for and the source document that is linked to each. The source document that you would transfer the information from for that particular book of original entry. So once you get a particular source document, you should know which book of original entry to make a record of the transaction in. So here we go. We begin with purchases journal, and the purchases journal is simply used to record goods bought on credit. The source document that you would use to record information from to the purchases journal is purchases invoice. And here we have a sample invoice. The invoice, different businesses would have their personalized invoice. Some may just buy a regular invoice book from the store and have it written up, while you have some businesses, they have their personalized invoice that they purchase from the printing company, which would bear their name and some basic information that they can just write in. Or some businesses, once they're using the electronic accounting system, then the invoice would be generated from that. So a typical invoice shows the name of the document, the name of the supplier, the customer's information, name, possibly the address, etc., the date on which the transaction took place. Remember, the source document serves as evidence. It can tell you when the transaction took place as well. So the date is important. It will show you the quantity, how much of a particular item that was purchased, the type of item, the cost per item, and the total value for the set of items that you have purchased. The invoice, as you're seeing 3 different types of items right here, because guess what? These were purchased at once. So therefore, they use us a one invoice for that. You're seeing the total that is due. If it is that a discount was given, a trade discount was given, that information would have been provided on the invoice as well. Terms are given. So once the goods are purchased on credit, then a business may say if you pay within 15 days, you'll get a cash discount of probably 10%, etc. Or otherwise, payment would have to be made within 30 days, etc. So what they tend to do is to put the terms on the document as well. Notice the number that is on it. A part of internal control is that each source document must bear a unique number. Okay, so that is what you'll use to track the transaction as well. So we're going to look at sales journal, and it is used to record sale of goods on credit. So once you sell goods to your customers, they didn't pay for it immediately. Once it's a credit transaction, then that's recorded in your sales journal. If it is that the goods were sold for cash, it is not the sales journal. It is only if payment is to be made at a later date, your trust. All right. So what is the source document? Similar to the purchases, and that one is sales invoice. Typically, the same way it would look is just that once you're selling, your business name would be at the top because you are the supplier, and the customer name would be written there, etc. The reality is In preparing your sales journal, you would know at the end of the period the total goods that were sold on credit, total value of goods sold on credit. Backtrack to the purchases journal, that would give you the total value of goods purchased on credit and from whom that was purchased. Okay, we're going to move into the returns inwards journal, where that is used to record goods returned to the business by credit customers. So goods returned to the business by the debtors, basically, right? At the end of the period, you would know what is the value of goods that were returned back to the business by the customers. And the source document is credit note sent or debit note received. If it is that you got the goods from the customers, you're going to prepare from your end as the business accountant or clerk, accounting clerk, a credit note and give to those individuals, because you're going to let them know that. Because, and the reality is, what some businesses do, they don't give cash refunds. So instead of giving cash refund, they would say, I'm going to give you a credit note, you can use it, it's valid for a year, and you can always use it to make purchases within the business. And this is done when you basically is unable to find something in exchange for the item that you're returning. So once there's nothing to exchange, then of course you're going to issue a credit note to the customer, because you're showing them that you are owing them that particular value, and they can always come and retrieve something from your store worth the value of the credit note. If it is that it is more than they purchase something that is more than the value of the credit note, it means that they would have to pay the additional cash, or they would owe the business that particular extra value from that purchase. A debit note can be received, and this means that from the customer's end, they could prepare a debit note. And once you receive that debit note, it is basically indicating that goods were returned to your business at whatever value. And then that you would use that information to record in your returns inwards journal. So remember, the return inwards journal is used to record goods returned to the business by credit customers, and the source document, credit note sent or debit note received. If it is that you're not going to say credit note sent, but you say credit note, it means that it is returned inwards. Okay? But if you say debit note, you'd have to say debit note received in order for the examiners to accept your response as a source document relating to returns inwards journal. Here is a sample of the credit note. Basically, remember, the name of the document has to be shown on it. It has to be pre-numbered. The name of the supplier information is there. To the customer, the date, the description of the goods, the quantity, the unit price, the total, and you're seeing that the value of the credit note is $146.88, meaning this is the value of goods that were returned to the business by the customer. The return outwards journal is used to record goods returned to the business credit supplier. So the business is returning goods back to its suppliers, basically the credit suppliers. So these are the creditors. Your business is returning goods back to the creditors. For whatever reason, the goods are returned. Once goods are returned to the suppliers, those are recorded in your return outward journal. And what will be prepared as a source document from your end? From your end, what you would do is prepare a debit note. If your business is sending the debit note, it means that your business name would have to be right here where you're seeing McCoy Wholesale Limited, and the name of a document would bear debit note on it. For the credit note received, your supplier's name would be right here, and your name as your business name would be written there. The same process you would go through in writing the quantity description, unit price, total remains. It's just that the title, the heading of the document would be different if it is a debit note. So this is the difference between a debit note and a credit note. The cash book is used to record all bank and cash transactions. So if it is that you make a payment, you receive a payment, whether it is by cash or by check, that is recorded in your cash book. So the cash book is used to record your bank and your cash transaction, payments and receipts, basically. And the source documents, there are different source documents that are used. You have cash receipts and you're used to cash receipts, because if you go to like KFC or Popeyes, or if you go to say Price Mart, Walmart, wherever you go, once you pay for an item, you will get a receipt. From your business end, the business can prepare receipts and give to the customers as well once they make a payment, once they purchase something and they have made a payment. Check counterfoil is used, so when they're paying out a check, the counterfoil, what remains in that checkbook, is referred to as counterfoil, and that gives you the name of the person that you have paid. It gives you the number, the check number, etc. The amount as well, right? Cash register tape. The cashiers at the end of the day, the register would give them basically a printout of all the receipts that were generated, all the amounts collected on a daily basis. Bank statement simply tells you the amount that was paid into your bank and the amount withdrawn from the bank. So money paid in and money taken out of your bank account for the period, and the bank would prepare that and give to you as an account holder. Paying in slips, basically deposit slips, and there are other things. You have withdrawal slips as well. So we're going to look at an example of a till roll. This is basically the cash register tape as well. And here's a look at it. Simply giving you a printout of all the transactions and the amounts that were collected. Next, we have just a simple copy of a receipt, giving you the name of the organization, the invoice number, the person that, the salesperson, the date on which it was prepared, the transaction took place, what was purchased, the value of it, the tax collected, etc. Method of payment as well can be shown on receipt. And here's a blank copy of a receipt. This is an example of a receipt page taken from a book that was purchased from a store. So some businesses may decide to customize your thing, some may not customize it. So all they can do is just purchase a receipt book and make the entries. So they would input the entries as necessary. So those are just two samples of source documents used to record in the cash book. Remember, there are others. We're now going to look at petty cash book, and the petty cash book is just simply used to record small payments, small cash payments. So a business may say any payment that is lower than 2,000 or below must be made from petty cash fund. So anything above that would be made from the main cash record. So, and that would be recorded in the cash book. And what a business may tend to do is to have like a regular accountant as well as a petty cashier. The petty cashier is the one that would manage the petty cash fund and make all those small payments. So if we go back to that example of 2,000 or below, once payments are to be made within that range, the petty cashier would be responsible for that. And the source document for petty cash book is petty cash voucher. And here is a simple sample of a petty cash voucher, and it shows the name of the document, petty cash voucher. The pre-number is 302. Remember, each source document as a part of internal control, tightening of internal control, documents should be pre-numbered, and it bears the item that was paid for, the amount. It must be authorized by the petty cashier, and the person that receives the amount would sign to it saying that they have received the payment. Okay, so remember, once you have a petty cash voucher, that's recorded in your petty cash book. The difference between the petty cash book and the cash book is that the petty cash book is used to record small payments, and usually a range is given so you can know whether you're going to make the payment from the petty cash book or from the main cash book. Okay, and now we're going to look at the final book of original entry, which is the general journal. So before I get into the general journal, we have looked at the purchases journal, which takes into consideration all the purchases made on credit, and that would be goods purchased on credit. The sales journal used to record all goods sold on credit. The return inwards journal is used to record goods returned to the business by its customers, returned outwards, goods returned by the business to its suppliers. We looked at the cash book, which is used to record receipts and payments of cash or check. We look at the petty cash book, which is used to record small cash payments. And there are some other transactions that we have not looked at. And those transactions will be recorded in the general journal. So the general journal is used to record all other transactions that are not appropriate for the other books of original entry. If it is not credit purchases, credit sales, return inwards, return outwards, if it is not payments or receipts of cash or by check or any payments or receipts at all, once it is a cash transaction, meaning payment was made, it means that that will go to your cash book. If it is not small cash payment, then of course it goes to your general journal. And examples of those would be writing off of bad debt, the purchase and sale of fixed assets on credit. Once you purchase or you sell fixed assets, remember it is not good. So do not record in your sales journal nor your purchases journal. It is a fixed asset, so therefore that should be recorded in your general journal. If payment was made, that is the cash book. All right. Other entries for the general journal or transactions for the general journal would be to record adjustments such as prepayments, to record depreciation, to do closing entries, to the opening entries. So those are some uses of the general journal. And the source documents varies. We have invoices, emails received from other businesses, letters, emails sent to other businesses. So those are some examples of source documents for the general journal. That takes us to the end of this lesson on the introduction to books of original entry. Remember, there are 7 books of original entry. We have the purchases journal used to record goods bought on credit. Sales journal used to record goods sold on credit. We have the return inwards journal that is used to record goods returned by our credit customers to the business. We have return outwards journal used to record goods returned by the business to its credit suppliers. The cash book used to record receipts and payment of cash or check. So once payment is made or there's a receipt, then of course that goes to our cash book. Or petty cash book used to record small cash payments. And remember, there's usually a range that is given, so you would know if the petty cashier would take on this transaction or the accounting clerk or the accountant, which would make that entry in the cash book. And the final thing is the general journal to record all other transactions, such as writing off of bad debt, making other adjusting entries such as depreciation, provision for doubtful debts. We have to close off accounts, you do closing entries, you do the purchase and sale of fixed assets on credit, and also to record opening entries.
Like, share, and don't forget to subscribe.